Hello and welcome to the Gold Goats and Guns Market Report for today, the 15th of September, 2024. My name is Tom Luongo. We have a lot to talk about. Let's get started. Friggin' housekeeping this morning. I have too much stuff to do. Okay, folks. Let's talk about this situation with UK and the Fed on Wednesday and rate cuts and all of it. I was asked a very detailed question by some people on Slack this morning, trying to get up to speed because they're not bond experts, and that's okay. If you're not, there's no shame in that, folks. I hesitate to call myself a bond expert today, and 3 years ago I barely understood what a reverse repo was. So now, that being said, I still have to remember. Yeah, okay, fine. Now, with that said, the thing about the FOMC meeting this week is the following. You know, there's a lot of potential issues with this thing, and it's going to be interesting. We're going to talk about it Wednesday morning as well. But let's try and integrate what's going to happen at the FOMC with what Alex has been talking about, Alex Krainer's been talking about. And, you know, I've been trying to help him elucidate into the world and for people to understand. At this point in the process, at this point in the cycle, it's not necessarily about where rates actually are. It does a little bit. I want to remind everybody that really what's being managed here are credit spreads, right? I keep putting up the U.S. UK or the U.S. German spreads between, you know, their respective 10 years and 2-year debt. I've got an update to that chart this morning to make it a little easier to read because we've been tracking it on a daily basis for 3 years. So those spreads are really important. Why are they really important? Well, because every company that does international business and does business in multiple currencies is going to wind up with balances in those currencies, and they have to, you know, hedge the potential risk of holding that currency for any length of time because exchange rates fluctuate. So what do? They set up an interest rate swap, a form of derivative contract, in order to hedge that risk. Okay, so that, you know, if you're you know, a Norwegian oil company and you're, you know, selling your oil in dollars, and you have a whole bunch of dollars, you not only do you want to convert that into an asset of some form or another that's providing you some yield, but you also want to offset those dollars with your insert in such a way that you have a what feels like a constant rate of return or constant valuation in Norwegian krone, which is how you have to pay your operating costs. So that's why companies do this. Like they need to pay their operating costs for the most part in their local currency, in their native currency, pay their bills and their taxes and their suppliers and their labor and blah, 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 blah. Most of their costs are going to be in their native currency, but they have balances of other currencies. And so they set up an arrangement to ensure that if there's a move in the exchange rate of one versus the other, that they don't really lose a lot of money. And maybe they make a lot of money. If it moves into their favor, if the exchange rate moves in their favor, then they make a little money. And if it moves against them, they lose a little bit of money. But they set up a swap arrangement so that within a certain band of exchange rates, they don't really make or lose any money. And that's what they're hoping for. It's when you get outside those bands that everything goes kerflooey, and then the swap contract is either executed in order to, or it's having to be put on, or whatever they have to do. And like, this is where my understanding of this stuff is murky, because I've never done this. I've never like set up an interest rate derivative swap of one currency versus another. And I'm a tactile learner. I have to like do things. I have to move pieces on the board. In order for me to learn a board game, I can't just read a rule book and go, oh, that's how the game works. I'm going to do this, this, and this. I have to literally move pieces on the board and buy tiles and buy cards and play them and whatnot. And then I can grok how the game operates, because that's the way I learn. I don't learn by reading. I don't learn by listening. I learn by doing. And so if some of this feels a little off or wrong, it's simply because I've never done it personally. Okay. So again, professionals in the audience, if you want to explain the finer points of this, or refer people to assets that are out there that'll help them understand this, great. But what's important, taking a step back from that, is that those are all over the market. That's where that 1.15 quadrillion, dollar derivative number keeps getting bandied about by people like Catherine Austin Fitts and others, and they talk about this number all the time. And they're right that they, in some ways, that they represent a kind of time bomb, because a lot of these are, they have daisy chain dependencies. So if one guy goes, so there may be 4 or 5 or 6 people in a chain on some of these derivatives, and if any one of those people in the chain can't pay, then all of a sudden, the whole thing, the whole system, the whole regime of these things collapses, and now someone doesn't have any money to pay. I've said many, many times that in a derivative contract, there's a difference between notional and net exposure, right? The notional value of a contract of one of these things is the amount of money that's, being hedged. But the net payout, if the contract fails, is much, much smaller. Okay. So you hedge $1 billion worth of risk, right? Worth of assets. And if you bet wrong, you're on the hook for $50 million payout or $10 billion payout or whatever, right? That's why they set these things up, is to minimize their potential losses, right? But that means that someone's got the counterparty on that trade, on that contract, and they're going to pay out if the contract fails. Well, what if that guy can't pay? In many of these derivative contracts, I like to say notional becomes net. The notional value of the contract becomes the net value of the contract when the other guy can't pay. And so, you'll hear guys like Jamie Dimon go out there and go, yeah, there's $1 quadrillion worth of derivatives, but the net's nothing. We can absorb the net. That's not the big deal. Well, it is, as long as somebody's willing to step in and liquefy the guy who can't pay and pay off the guy who is supposed to get paid, right? And that's what the central banks are supposed to be. Really, that's what their primary job is supposed to be there as a source of emergency liquidity when there's a time mismatch between, someone's ability to pay and their contracted requirement to pay. And that's what the central banks are supposed to do. That's what they were set up originally. At least that's what the Federal Reserve was set up originally to do. Okay? It doesn't do that anymore. It doesn't. It's a completely different institution at this point. So with that in mind, as I try to get my cigar relit, let's talk about what's going on with the Bank of England and Ukraine's debt. Now, what's important is the way the market is currently trading, what the market's expectations are. That's going to set where these contracts are written and what's going on and blah, 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 blah. And there may be a lot of them out there. New contracts are going to be written around the current pricing regime. Old ones may blow up if the exchange rates get out of control or the spread or the interest rate spread gets out of control. If one of those two things happens, the trade blows up and then someone has to pay. Well, what if the other guy can't pay? Then the central banks are on the hook. And that's kind of what Alex is talking about. What I'm getting at here is that the markets are priced for 50 to 75 basis point rate cut on Wednesday. But what if Powell only cuts 25 basis points because stock markets are at an all-time high, the CPI and the PPI came in hotter than expected, employment data didn't fall off a cliff the other day, and blah, 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 blah. What if Powell only cuts 25 basis points when markets are expecting 50 or 75? Well, given that the reason we think they're expecting that high a cut is because the inversion on the yield curve, especially in the belly of the yield curve between 6 months and 2 years, is screaming that that's what's going to happen. Everybody's betting on that. And that's also affected the long end of the yield curve, because not only are the inversions high, the internal spreads high, but the whole yield curve has come down drastically, right? When bond yields fall, prices rise. So now we're sitting here watching the Bank of England and the ECB managing credit spreads at this price regime. Now, I think what they were hoping for is that they bought low and they were going to sell high. They were going to buy at 4.75% on a 10-year U.S. Treasury and sell it at 3.6% and make money on, and then help and recapitalize and fix the hole in their balance sheet by selling those off. But what happens if Powell only cuts 25 basis points? Credit spreads start to blow out. And what's going to happen to the long end of the yield curve? It's going to start to rise. Okay, bond prices are going to fall. Bond prices are going to fall, or are going to try to fall, and bond yields are going to rise. But the ECB and the Bank of England want prices to remain high so that they can sell hundreds of billions of dollars into the market and make 10, 15, 20, 30 billion of real money off of the trades that they've already made by having bought hundreds of billions of dollars worth of U.S. Treasuries. As I pointed out, by breaking the TIC report down by region. Now, they're caught between a rock and a hard place. What if Powell cuts by 25, the bond market, the long end of the yield curve starts to sell off because the Powell has disappointed the markets? The speculators who have front run at the idea of a 50 basis point cut have, and by the way, don't kid yourself, the BOE and the ECB were in there. Of course, they were in there bidding up these prices. And now they're going to try and they will try and dump into the sell-off? No, they can't dump into the sell-off because they can't afford to have their own bond yields rise very far. And they can't afford to have the spreads between different types of, between their debt, say the German debt and the U.S. debt, get out of a particular band, which is why I keep putting up the chart of the German 10-year and 2-year rate differential between that and American and U.S. debt, and watching it fall, which means that German debt is rising in yield relative to American debt, because it's, German debt's trading below U.S. debt. So therefore, as that spread collapses, as German debt rises to meet U.S. debt of the same maturity, that spread is falling. That's what Lagarde has been trying to manage. Okay? So what I'm arguing here is that the counterintuitive play might occur that Powell disappoints. The long end of the curve starts to sell off immediately. And what do the BOE and the ECB have to do in order to maintain credit spreads as bond yields are falling, or as bond yields are rising and prices are falling? They're going to have to buy more. They won't be able to get out of their trades. They're going to have to buy in order to blunt the fall in bond prices. They're going to be buying. Powell could force them into buying the top. That would be hilarious, because if he cuts by 75 basis points, the U.S. 10-year will stay at around 3.6, 3.7%, because everybody's going to expect that Powell's going to cut down that far over the next year, and therefore everybody can get out from underneath the trade that they've made. But if he disappoints and keeps rates effectively higher for longer than the markets are expecting, than these people are expecting, they're going to be forced to keep buying. And now they're buying at the top. They're not buying at 4.75% while shit's going on. They're buying at 3.6%. All they're doing is digging themselves an even deeper hole, because now they're buying. Now any rise in yield has them fucked. And their balance sheet, they're buying, and their balance sheet is degrading at the same time. If markets were pricing in a 25 basis point cut, I would not be explaining any of this. It's only because markets are expecting blackmailing Powell into doing this, that they've set themselves up in this vulnerable position. And either Davos et al. Believe that they, have the secret sauce and they have this in the bag, or they've bet the farm on a policy that they can't, they've bet, that the markets can't cash. They're writing checks the markets can't cash. Okay, this is important because if Trump wins the election, what do you think is going to happen to what do you think is going to happen? Well, I do expect Powell to cut more aggressively once Trump is ensconced in the White House. That could be 6 months from now or more. What if the election isn't decided in the courts until March? Like, the longer they fight and tooth and claw to install Kamala Harris so that they can get rid of Powell, so they can have the interest rate regime that they want, the worse it gets for them, because Powell's going to hold interest rates high into that uncertainty. And the market is going to demand higher interest rates into that uncertainty because the American political system is a mess. No amount of central bank buying and front running by our own treasonous treasury is going to stop that. There comes a point where, unless the bond markets are completely fake and gay, and then I'm shutting down this fucking market report and I'm just going to talk about, puppies and cats and freaking World of Warcraft on every Wednesday and Sunday. Because if the bond markets are this freaking fake and gay, that they could hold U.S. interest rates at 3%, long-term interest rates at 3% during a constitutional crisis of who's going to be fucking president, well, then we don't have capital markets, folks. And this thing is already done. But I don't believe that. I believe we still have the vestiges of capital markets. And I believe that with Powell at high interest rates like this, he's actually restoring capital markets. Remember, as Daniel DiMartino Booth trenchantly and puts it, at the zero bound, the Fed is not even a central bank. It's just a money printer. And we've lost now the last money printing central bank, i.e. the Bank of Japan. So let's watch this. This is what we should be watching for coming into Wednesday. Are people going to get cold feet coming into Wednesday? Are there going to be announcements or, dog whistles from various people letting everyone know Powell's only going to cut by 25? So, watch Nick Timiraos over at the Wall Street Journal. All right. While I believe he's a mouthpiece for the regime, he's the closest thing we have to a Fed whisperer at this point. Danielle thinks that we're going to have 50. She said that on a fishing boat while she was hanging out with Michael Gayed recently, the Legal Ag Report. I don't know. She may be right. Danielle's instincts are excellent. But part of me says 25 is very possible, but the markets are not prepared for 25. And, I've heard other people say, and who I also respect as much, if not as much as I do Danielle, say the Fed doesn't cut 50 basis points unless there's a freaking emergency. And if that emergency is the bankruptcy of the Bank of England, is that enough to spook Powell into having to go 50 basis points because he is worried that there will be sufficient blowback on the United States banking system and interest rate markets that he has to do that to minimize that damage? But if he does do that, does he also activate Ueda over at the Bank of Japan to blunt the effect of him cutting by 50 for the domestic market to shore up, to offset a domestic liquidity crisis, but still enforce the amount of global tightening of the dollar markets that he wants to enforce? if I'm right about all of this, about my arguments here about Powell, Bank of Japan, and Wall Street wanting to break the eurodollar market and break the global Fed put and have the Fed go back to being closer to its original mandate, as Martin Armstrong has argued strenuously, that, the original idea of the Fed is not that bad an idea. Just have a bank that's capable of producing a little bit of elastic money to help time mismatches, but nothing more than that. Of course, the Austrians and the libertarians in the audience are saying, well, look, we know that these institutions get corrupted over time. So, once you let the camel's nose under the nose under the tent, like, eventually the camel's in the freaking tent, and it takes up all the room. And that's what's happened. We live in a world dominated by central banks. And I don't know that, effectively 8 years or 9 years of Jerome Powell will be enough to reform the Federal Reserve to the point where it could, operate as a domestic central bank or not. I have no idea, folks. But I can definitely see that's where we're moving. That's what the sum and substance and total of Powell's moves over these 7 years so far lead me to that conclusion. You can disagree with me if you like. I know there are many people in the audience who listen to me ramble, even though they fundamentally and virulently disagree with me. Fine. Your money spends just as well as the people who agree with me. I'm okay with that. So that's the story that I see laying out for this Wednesday. And I don't think anybody really has that strong a handle on it, but it's putting all of these pieces together, then thinking about what the incentives and the realities are for the people who are most vulnerable to Powell's higher for longer shtick. And what do you got? You come up a cropper you come up the ECB and the BOE every friggin' time, come a cropper every time. Like, that's the outcome. So that's what I see. Now, does that feed into this desperate need to escalate the war in Ukraine? Of course it does. Anthony Blinken and David Lammy go to Kiev. I refuse to say Kiev. Kiev. To bless the Ukrainians' use of long-range missiles to strike Moscow. Putin responds saying, look, if you do that, we know the Americans are the only ones who can give you the targeting information necessary to fire these things and have them actually get through our missile defense systems. Therefore, that will be a state of war that will exist between NATO and Russia. Is that what you want? And there was a good article on RT this morning. I know I'm not supposed to actually go to RT. I'm a bad person. I pariah, outcast, unclean that I am. But all that, the only reason I went to RT for this information is because I hate the British media so much more. And there was an article in the British Times, the London Times this morning, saying exactly this, that if Ukraine launches those missiles, Britain and Ukraine rely on GPS, and the Russians jam GPS. The Americans have a different targeting system. They have a different satellite network that the Russians don't have the ability to counter. So if we're firing those missiles and we want them to be effective, or if they are effective, that will be prima facie evidence that the Americans are the ones giving Ukraine and the British the information necessary to land those missiles on target. Ergo, the U.S. is actually a combatant. Now, that's what Blinken wants. That's what Newland wants. That's what, Chrystia Freeland over in, it's what all the Ukrainian mafia within the State Department and the National Security Council. And why were those people put there? They were put there in order to foment World War III. Or at least scare people enough, certainly in Europe, to the point where that it could occur that they need to band together under a fiscal and monetary rubric and political rubric of the EU that they're to that point they're uncomfortable with. Okay? Or to this point they were uncomfortable with. But they don't actually want nuclear war because they know that there won't be an EU if there's nuclear war. It's not like the Russians are confused about who the aggressors are here and who the decision makers are. Putin and Medvedev and everybody else has already told everybody who they think the decision makers are. And the Pentagon then turns around and says, but yeah, and Biden turns around and says, yeah, but you're not going to get any of that. You're not getting the ammunition. So Blinken, blesses the permission to use these missiles this way. And the Pentagon says, yeah, that's nice. You're not getting the missiles. But if you use the British missiles, well, you may not get our help. At the same time, Zelensky and company are now calling for peace talks and allowing Russia to actually show up to their own peace talks, which is, mighty white of them. And it's ridiculous. And Putin has repeatedly said, we are uninterested in any quote unquote ceasefire that allows Ukraine to rearm, reload, and regroup. There will be a complete surrender of Ukraine, or there won't be. And of course, now the neocons like John Bolton and the rest of them are all saying, prove it, Putin. And Putin's like, I don't have to. Every day we take a few more square miles and we kill a lot more Ukrainians and we kill a lot and we destroy a lot more NATO hardware that you guys can't replace at the rate at which we're killing it. We're winning. You can't replace the men. You can't replace the trained troops. You can't replace the tanks and the rockets and the drones and the this and the that and the anti-air. You can't replace any of it. So we're just going to continue to do what we need to do. And to anybody who says, where's the Russian Air Force? Why bring the Russian Air Force in when you can win a ground war with drones? Why give NATO and the U.S. military-industrial complex the information and the reconnaissance that they desperately want? Don't give it to them. It's why none of these advanced weapon systems have actually been used, folks. I know there's a significant group of people out there who believe that none of this shit works. And it's a fair assessment of the situation to look at all of the data and then come to that conclusion. I happen to disagree with that conclusion, but I can see why you would come to that conclusion. And I've been arguing with people behind the scenes about this in private conversation, and I'm like, I don't really think that's what's going on here. I think I think both sides don't want to bring their best stuff to the table because they don't want to give the other side the information that they need. And certainly if you're the Russians, why would you do that? When you can fight a low intensity and low consumption in terms of trained manpower conflict in the Donbass, where the outcome is inevitable unless NATO comes in and starts bringing in tens of thousands of trained troops, which we know they won't do because Radek Sikorski, of all freaking people, told the Vovin and the other spoofer that that's not going to happen. Polish troops are not going to wind up on the ground in Ukraine unless they're there as peacekeepers after a ceasefire. So, of course, now we're trying to talk ceasefire, which is nothing new, and the Russians are not going to fall for that. So they're going to continue to do what they're doing. This war is not going to change unless somebody escalates to the point where they force Putin into becoming the new Hitler by forcing him to escalate beyond his ability to counter. Okay, Putin doesn't have a smooth escalation curve from here, is I guess the argument. I've discussed this extensively with Dexter White, and it's clearly the position of the crazy neocons But they may not be crazy, folks. You have to assume they may actually have some good information out there. And and that they're acting rationally. They understand that Putin doesn't have a smooth escalation curve. To him, he's got a step function. We go up to this level when we're at that level now, or we go to the next step function. And that step function is attack nukes. At which point, Putin loses any moral authority that he would normally have, that he would have. And that's the gambit. Drive him into a position where he does not have any other practical option but to do that. And then the question is, will he lose all of his allies in the process? And will the West be able to sell this now as a Christian just war? Even though none of them are freaking Christians, they're all goddamn Satanists. Like that's the story. And this is part of the reason why I said, I think I said it in the previous market report, and I know I said it a couple of times in public last week when I was doing the various media that I did, and I'm kind of a little checked out on all this because at the end of the day, we know what the story is. All the twists and turns of the story don't really matter. We're waiting for the other shoe to drop. I think that other shoe drops in early October if Powell disappoints markets on Wednesday. Let's bring it all the way back around to the beginning. If Powell forces the Bank of England and the ECB into a kind of bankruptcy spiral, having to buy U.S. treasuries that they can't, at the top, that they'll never be able to sell for a profit, and they'll always be underwater on, then the next move is to force a liquidity crisis on the Federal Reserve to push them back to the zero bound. Or am I missing something? Meanwhile, the Saudis, like the Chinese and others, are buying shit tons of gold, metric shit tons of gold, trying to hide it from people. Nothing new. Been going on for years. The Chinese come out, the Saudis also come out in the same week and say, hey, we're open to the idea of the petro yuan. Now, is that just a negotiating tactic on the part of MBS in order to get like U.S. weapon systems or whatever possible? But the reality is that we're only a couple of weeks away from the BRICS summit in Kazan. Clearly, we've made a big move to turn Brazil and India. The U.S. has worked on Brazil. The British are working on India to have them be snakes in the BRICS garden. Clearly. And this is another reason why Putin really can't do that step function escalation. Because he's got to try and hold all this together. Trying to get that in place. So he's being pressured on multiple fronts. And we'll see. And, we can argue amongst ourselves. And when I mean argue, I mean, in a kind of classical sense. I don't mean with vitriol and teeth and spitting and all and being angry. Just an argument. Classically, let's put arguments together. We can argue what those potential outcomes are. And that would be interesting. So this is the way I see the world right now. And, as always, you look for asset classes that are acting like canaries in the proverbial coal mine. And gold is clearly doing that. And so we have, a new all-time high in gold. Isn't that great? On Wednesday, I'm like, this pattern looks good, but, if they run it sideways for a couple more weeks, as I said on Wednesday, they're riding it sideways for a couple more weeks and they bleed off the momentum, and you get all the classic technical indicators that, frankly, sorry, dumb people use. I can't, I shouldn't say that, but I just disagree with that whole, I like RSI and stochastics and MACD and all that. Just so silly. The chart tells you everything you need to know. Why go crazy, right? Why complicate things? Keep it simple. Because at that point, if they'd run it out for a couple more weeks, the momentum could roll over. All the momentum indicators would start to turn sideways. Everybody would be like, well, I don't know, gold can't seem to get anywhere. And then everybody gets cold feet, and then somebody comes in, and that sets the market up during that period for a Mr. Slammy moment. And then, Bob's your uncle, and we get a $200 washout in the price of gold. Or we get Friday. And, that's what I love being friends with Vince, because, Vince having his hand in this stuff every day, actively watching, the trading data on these markets, he sees the fingerprints of what's coming. So when Vince says, look, gold is going higher here, like, I tend to believe him, like, you know what I mean? So I had when I was spinning that scenario out on Wednesday, I'm like, 75% this thing's going, in my back of my head, 75% this thing's going higher, not lower. Part of that is because of some of the things that have been said. Part of that is my own, I don't call it bias or interpretation of events, or just looking at the chart. Well, what my ghost is telling me, as it were. And boom, we get the beautiful, beautiful move on Friday. No, Thursday and Friday. And are we going to get more? We should, but, will we? It's always a good question. Whenever you get, $50 up, well, we got to trade sideways for 3 weeks. No, you can go up $50 again. It's just silly. Like the proverbial animatronic that, it's like, you moved them too far. Like, pull it back. So there's nothing else to really say here other than gold looks great. You can see the power of this formation right here, breaking higher on that bar, then 3 weeks to the sideways to consolidate the new gains of 2,500, round number bingo, as Jim Sinclair, God's rest his soul, would say. And then boom, we're on our way. And I think the next stop then becomes either 2,750 or 3,000. And then we'll talk. But, we're not going to see 10,000 anytime soon, but we're going to get there. The trend is in place. Everything looks good. The story is the same on the weekly, monthly, quarterly, and annual chart in gold. That's all you need to know. Everything else is just a chase scene. It's just noise. Silver. On Wednesday, I was complaining about the false move, the potential for the false move down, right? We had the downtrend, the 1-bar reversal, follow through, bearish engulfing bar, setting up a 2-bar reversal, and then boom, Thursday and Friday's rally to close above all of this nonsense in here. So this is all bullshit. This is chart noise. This is chart bullshit. This is what manipulation looks like. This is what a real market overwhelming the bullshit. Also, copper's $4.22 a pound. Copper's bounced off $4 a pound. The industrial metal sector is starting to get off the schneid. Okay? The NASDAQ is not rolling over still. The NASDAQ is getting, and the NASDAQ put in a good week. So silver looks good here. Closing above these highs, very important. Now we got to close above. We got to get a weekly high close above this high right there. Okay, so that these highs in here, as long as we get a closing price in here, then we can challenge. That would be immense. I mean, closing above that would be huge. That would be telling you that we're going to $40 and that there's going to be an epic short squeeze from here in silver. Because again, downtrend has been broken. High, low, lower high, lower low, lower high, higher low. Boom. The downtrend is now dead. definitively with this bar. Okay. I'd like to say that's the case in Bitcoin. 3 times has Bitcoin definitively put in a massive bullish move to the upside, only to be beaten back with the ugly stick of government coordinated selling. And then there's something about Coinbase writing IOUs to BlackRock's ETF, and like, so BlackRock doesn't even have the Bitcoin that they say they have on their books. And like, what a shock. BlackRock's at the center of creating paper Bitcoins. What a shock. Think is desperately trying to keep his freaking balance sheet from imploding. Because alongside the Bank of England, BlackRock is heavily invested in the reconstruction of Ukraine. So, beautiful little move here in Bitcoin. Again, here, boom, 2-bar reversal, 1-bar, massive washout, downtrend, 1-bar reversal, 2-bar reversal, 1-bar reversal. Again, so much bullshit. Again, so much bullshit. But we still haven't broken the correlation to tech stocks. The NASDAQ had a good week. Silver had a good week. Bitcoin had a good week. You have to respect it. Brent crude. Again, nothing has changed. The Brent crude market is fake and gay. We have inventory draws across the board. We have data. We have non-confirmatory data everywhere. Oh, BroPEC Plus is not talking about production cuts, even though the Western media likes to like throw ideas out there in order to influence the AI headlines that are scraping, that are actually doing the trading algorithm, that actually doing the trading, right? This is complete and utter bullshit. Oil should be trading at $80 a barrel. And to the people in the audience, and that are angry with me for saying, why would you want to root for higher oil prices? That's only hurting the American consumer. I also want oil to be investable. Oil is not investable at $70 a barrel. It's not. We've reached a sort of break-even price in the across multiple domains within the U.S. production space. You're going to have wells closing or shutting down. Oil field services are going to go into retrograde. So the American consumer can't afford $3.50 a gallon. Well, they actually can. Well, no, they can't. But we could have $85 a barrel oil and get rid of the ethanol blending credit bullshit, and we could probably go back to $2.50 a gallon gasoline, even at $85 a barrel. The market's not real. It's being manipulated politically on purpose for political reasons, and they've mapped out how it's going to play. We're going to wind up with a high oversupply of ethanol, and then are we going to have to subsidize the ethanol industry again in order to try and keep those jobs from being lost? It's all bullshit. Get rid of all the subsidies, unfuck these environments, get rid of all this wasted capital, and let farmers grow food for food production purposes. Let oil drillers drill for producing gasoline and diesel fuel, and let the market drive out arbitrage, profit arbitrage. Let's increase the technology and then when oil gets too expensive, let alternative forms of energy of a high density and portable nature come into the market. I hate to say this, folks, but given the debt situation, we need oil collateralizing the debt that's out there at $90 a barrel. Just do. Otherwise, you're still going to be paying 12% for your or you can pay 12% for your mortgage. Would you rather pay 7% for your mortgage and $90 and $3.50 a gallon for gasoline, or $3 or $2.85 a gallon for gasoline, but have to suffer through a 12% mortgage? I know what I would prefer. I know what hits my cash flow more. Gasoline is cheap. At the end of the day, you drive 1,000 miles a month. The difference between 50 cents a gallon and 20 miles a gallon, what is that? An extra $20? 50 cents a gallon. You drive 1,000 miles. You use 50 gallons of gasoline a month. It's $25, folks. Do you want an 8% mortgage or a 6% mortgage? That's $200 on your average 30-year mortgage today, a month. Gasoline is cheap. Oil changes are expensive. Tires are expensive. Oil is cheap. Gasoline is cheap. Still cheap. Patron request hour. Start with Loan Depot Incorporated. I highlighted here, found the highlighter button on PowerPoint for the first time. This is a weekly chart because the monthly chart looks like a flat line because the stock fell from $50 a share down to $2. So I want to go through this. So first things first, technically this is a textbook 1-bar reversal and follow through rally after a big downtrend. You could call this a reaction high if you need to. It's fine. Then we get a 2-bar reversal here and then a bounce on Friday when the general equity markets rally. This is a California jumbo loan company. I mean, they're one of those companies out of California that, still is issuing oligarchs 2% freaking mortgages against their $5 million estates and their stock portfolios. They're in trouble. That's why the stock has dropped from 50 down to 250. If you look on investing.com, it'll pop out that that's paying a 16% yield. It's not anymore because it did not pay a dividend in July. I looked, but it was paying 8%, 8 cents a quarter. Don't be suckered into this stock. Return on equity, negative. PDE, negative. This company is losing money at these prices. It desperately needs Powell to cut rates hard. They are likely really underwater on a bunch of high-priced California real estate, and this rise off the bottom, and you'll see this across a lot of these charts, in the hopes of a 50 to 75 basis point rate cut by the Fed. I don't see it happening. Be careful here. There'll be dragons in here. The stock may be fairly valued at around $2, and if you expect Powell to cut rates aggressively, the stock could jump back. Stock could be an easy double, but this is a spec bet, especially if it's not paying any dividends anymore. Okay. Mid-America apartment community. So California, Southeast, South, the kind of the Gulf states. I imagine, just reading the profile of the company, that they manage apartments from like Texas through Tennessee and down into Florida, right? That whole area. So red state apartment manager. This is a monthly chart that started to break higher earlier, at the beginning of last year on the hope of 7 rate cuts in 2024. It traded sideways for a bit, and as rate cut odds have risen and the long end of the yield curve has come down, the stock has rallied. Far better financials than LDI. 3.5% yield is probably sustainable. This is an apartment This is an apartment REIT, and homeowners, renters. I think that's what the patron who asked for these two was hoping I would comment on. I wouldn't buy either of these stocks, to be honest with you, but if you bought the bottom in here a year ago on the idea that the Fed was eventually going to have to cut rates, you would be up strong. This is a good, $50 on 110. It's a good 45% return while getting a 3.5% yield over that, you're getting an extra 3.5% to pay your taxes on, to use that to pay your taxes if you sell it. And this move is significant, but I don't know. Are we running into resistance here? There's what looks like an awful lot of resistance on this chart. And 3.5% yield, once REITs like this start getting below 3%, they start getting expensive. Okay. Just in general rule. All right. X trackers. This is HDEF is the name of is the ticker symbol. This is high yield equity ETF tracking the MSCI High Dividend Yield Equity Index. We had a solid breakout back here. Again, equities started rising on, especially as the Fed refused to cut interest rates. We started seeing high dividend equities rise. There was also the hope that the Fed was going to cut interest rates, and therefore high yield equities would then see inflows, which is what we saw. And it also, the point number two is this is, it's shrugged off. This is June, and there was a sell-off in equities into the end of June. This July, August. I was looking at this bar here when I made this note, but let's talk about. You can just as easily say this is August. It shrugged off the yen carry trade implosion because equities are moving higher, and now we're trading at an all-time high. Hey, global. In effect, this is a global equity index. This is not American-based. This is not European. This is a global equity index. I did not look to see what the weighting by country is in the index, but just say if this is truly global, it's got a little bit of everything in it. Then the global flight to tangible assets, along with gold, along with the breakout and what looks like a potential breakout in industrial metals, looks like it's happening. Now, the question is, does the market believe it across the board? Now let's look at Vail. I skipped a couple of other ones that are in the list because they weren't germane to the narrative for today. I will get to those later. After these three stocks, I wasn't going to put up a pharma company or another uranium company. I will look at uranium soon. Vail has gotten crushed and beaten with the ugly stick over the last 9 months or so, breaking. Once it broke down below support in the $12 area, it's now trading down around 10. This is a 12% dividend. The valuations are very good, and it's got positive return on capital. I don't think there's anything wrong with the company and industrial metals, and in general, they're in bad shape, and the company's balance sheet is still in pretty good shape. This might be a good potential contrarian play. I'd have to actually look into Vail's asset portfolio to get an idea of what's going on with the company. But I will say that at this price, this becomes a very interesting play, especially if you're handicapping an industrial metals and broad commodities rally into 2025 with the return of inflation, driven by higher commodity prices. Okay. For the first time in weeks, I finally put up the SOFR futures curve just to show you what's going on. This rise out here is very weird. Like the long end of this, the long tail out here, the bottom of the yield of the SOFR curve is now in early 2026. And I've been watching this. I check this thing twice a week. And normally this thing has been flat, all the way out or continuing to fall. And it's now rising. There's a 10 basis point difference between June of 2027 and the bottom of this curve. And that's new. So I note it because it's new, not because I have any idea about it, just that it's new. The market is starting to wonder if I think the market is starting to wonder if it's overdone it's overdone things here. I would agree with that sentiment if that's the case. Now, this is where we were at the end of the year, last year, that the market was expecting to be at 375 by the end of the year. Now the market is sitting here saying we're going to be at 4. That they're expecting 3 50 basis point cuts by the Federal Reserve in a row in September, November, and December. Really? As we've seen before, these curves can be very mispriced. And I believe we've reached another one of those moments where this is way overdone. For whatever reason, it may reveal desperation. It may reveal the fact that they're in complete control. You could make either argument and be valid at this point. I know what I want to believe. I present both cases to you. On Friday, with the rally in gold and everything else, the dollar sold off as the yen strengthened. We saw the dollar fall back a little bit as flows moved back into the euro and the pound. They were getting strengthened. There was a mild sell-off in the yield curve on Friday, a couple of basis points. So not surprised about any of that, but it's the unwind of the yen. The yen is now at 141 and falling, and it closed this week below the August 5th intraday low. That's a big deal. It means we've got a lot more downside or a lot more yen strengthening on the way. And with the yen strengthening significantly and oil prices low, Japan is reloading, folks. And note the Chinese yuan also at back down below 7.1. There's going to be a massive commodity bull run and positioning by both Japan and China that I think is taking advantage of the overpriced bond market. The black line here. Now, going into the U.S.-German yield spread. So I cut off the whole 6 months previous to this where we kept noting that that's when Lagarde put the transmission protection instrument into place. I pulled that off so that we could just focus on the last 2 years and the chart, because the chart was getting so noisy and so compressed that I couldn't, there was now no more information to be told. So we go back to all the twists and turns. And this is the big one. I added a new one over here. That's August 5th. Notice what U.S.-German credit spreads have done since the BOJ re-entered the game. Since the BOJ defended the yen. Credit spreads are falling. Lagarde panicked, or should have been panicking, the minute the 2-year and the 10-year broke down below out of her band, right? She wants this band. When it's above when it was above 1.9, she was like, okay, we can let it fall. But when it's below 1.7, she was like, no, get that thing back up there. And now we're at 1.5 and falling. I don't have any commentary as to what's going on in Germany with Saxony and Thuringia at this point, but apparently I saw a note this morning from a patron that said that who follows this and sends me a bunch of stuff on a regular basis, that the CDU can't form a government in Thuringia without Die Linke. They need Die Linke as well as Sarah Wagenknecht, BSW. And I don't know that anybody has a stomach for Die Linke to be. I don't see how the CDU makes that trade. What I see is nobody's going to make any moves until after the Brandenburg elections next week, and we see what happens to the Greens. If the Greens get knocked out, I can see the CDU finally just breaking the firewall, breaking the cordon sanitaire around AfD, because it makes the most sense for them to do it in one state. And if that happens, that will be prima facie evidence that the Americans are allowing the Germans to act in Germany's best interest, because then the goal will be a Germany that allows AfD to enter the Bundesrat is a Germany that's on its way to changing EU policy. And to me, it would confirm, inferentially, maybe third derivative inferentially, that of everything I've been talking about, that you're seeing the turn in Germany, because the goal now is to break open the EU and keep it from actually consolidating further power over Europe. We'll see. I may be wrong about that. Again, this may be rose-colored glasses on my part. That it's up in the air as to what all of this means. So let's just keep watching it, and more data will come in, and we'll get some better understanding. But there are a lot of different ways Germany could go here. But the big thing on the horizon is that if Germany is not respected properly, then the EU is done. And that's the big one. And so it's why the euro can't fall too far. It's why It's why a lot of things are happening. Okay. Oh, and just before we finish off, U.S. German 10-year spread, 1.5%. Japanese 10-year Japanese government bond didn't move. Copper back to 422. Gasoline futures are off the floor. They hit a low of 190. Now they're back to 197. Let's see if they can. Let's see if they break back above $2. Probably should, just in a bounce. But we need a. We're not going to get a technically significant move in gasoline prices, for a while. They're just too suppressed. They've fallen off the chart at this point. They have to go back to like 230 or 240 to even begin to repair the damage to the chart. Okay. Dow Jones. So last week we had the big sell-off. This week we had the panic bottom, and then we're here within a hair's breadth of pulling a 2-bar reversal and a false move down here. This is going to be interesting. The Dow is still just barely. The NASDAQ, I should have actually changed the NASDAQ's color here. The Dow is holding up really well for September, better than just about everybody else. For Q3, the Dow is clearly outperforming everything else. Okay. So, again, U.S. treasuries are up. U.S. stocks are up. Gold is up. Global high-yield equities are up. And Powell may disappoint on interest rates on Wednesday by, well, not us, but the rest of the world. Could be a very interesting week. Okay, that's what I got for you this morning. You guys be well. You take care. We'll talk soon. Keep your stick on the ice.